Welcome back to the Neuro Finance Masterclass. Today, on day 105, we decode the market's explosive risk thermometer. Yesterday, we mastered the intrinsic value of businesses through DCF analysis. But today we're shifting our surgical focus right back to the volatile, absolutely unforgiving waters of crypto derivatives.
And man, what a shift it is. Today is all about understanding when the entire system has literally pushed past the point of calculated strategy, right into the realm of pure, unadulterated risk. We're looking at a real masterclass in market psychology and, honestly, systemic fragility in this explainer.
So consider this fundamental rule for a second. When the market stops investing and starts gambling, the powder keg is primed. That perfectly captures the incredibly high stakes we're dealing with today. There is this massive structural difference between taking a calculated, mathematically sound position and just reckless market gambling. When the majority of the crowd crosses that line into gambling, the very foundation of the exchange actually becomes a trap.
Exactly. Hit the nail on the head. And the question isn't if that trap is going to snap shut, but when. As strategists, as the architects of our own portfolios, we don't just sit around guessing when that shift happens. No way. We measure it.
Ibrahim, Part 1. The Explosive Risk Thermometer, Measuring Systemic Market Risk. So, how do we actually know when the total system has taken on entirely too much risk? Well, we need a precise tool to diagnose when the market is no longer investing but just purely gambling. Let's kind of contextualize this with our timeline for a minute.
Right, so if you remember back on day 93, we covered funding rates to really understand the cost of holding positions. Then, day 94, we dissected open interest to see the total number of outstanding contracts. And yesterday, day 104, we looked at long-term intrinsic value through DCF analysis.
Which brings us to right now, day 105. We're going to combine that foundational knowledge of derivatives with a brand new metric, the estimated leverage ratio, or ELR. This brilliantly illustrates how all our tools build upon one another to forge the ultimate risk thermometer.
Part 2. Decoding estimated leverage ratio, the math behind the madness.
Now look, this isn't some abstract academic theory, okay? This is cold, hard, on-chain data. Let's decode the exact math here.
Yeah, the estimated leverage ratio is basically this on-chain metric defined as the ratio of the total open interest in futures contracts to the total coin reserve, things like Bitcoin or Ethereum, that are actually held across centralized exchange wallets. Simply put, you take the total open interest and you divide it by the total exchange coin reserve.
And what this elegantly reveals is the average amount of leverage being used by traders at this exact moment. It literally gives you a direct mathematical snapshot of greed. Notice the stark contrast here. It's absolutely crucial. On the left side, you have your total open interest. These are your paper bets, right? The leverage just floating out there in the system. But on the right side, you have the total exchange coin reserve. These are the actual hard assets sitting in the vaults. It's a really simple fraction, sure, but with terrifying implications. Think about it. If open interest is aggressively skyrocketing, meaning paper bets are piling up higher and higher, while at the exact same time the number of actual coins on exchanges is dropping, well, the ELR spikes aggressively. You basically have this giant mountain of paper promises balanced precariously on a shrinking pinhead of actual assets.
Part 3. The Inevitable Leverage Flush, Anatomy of a Flash Crash.
So that shrinking pinhead of actual assets, it leads us directly into a potential market disaster. When the ELR climbs up to these historically high levels, it's screaming at us that market participants are heavily, dangerously over-leveraged. The system becomes insanely unstable. In Turkish, we actually have a perfect phrase for this, a barut fıçısı, a powder keg. The entire structure is basically soaked in the gasoline of borrowed money, just waiting for a spark.
Absolutely. A historically high ELR means the safety nets are totally gone. It means the market isn't being driven by real spot buying or true demand anymore. It's just being artificially propped up by leverage. And you know what? That leverage eventually has to be paid back or completely wiped out.
And because that barut fıçı is so incredibly unstable, it really doesn't take some massive global macroeconomic event to blow the whole thing up. In this kind of volatile environment, traders have used such tight margins that all their liquidation prices are clustered tightly together.
Meaning, literally just a tiny, insignificant $500 price move in Bitcoin can be all it takes to ignite the entire system. Just $500. That is the tiny spark that hits the gasoline.
Let's walk through this rapid-fire domino effect because it happens fast. Step 1, because of the crazy high leverage, tight margins pack everyone's liquidation points incredibly close to the current price.
Step 2, that tiny $500 price drop we just talked about, it triggers the very first batch of liquidations.
Step 3, the exchange engine steps right in. Those liquidations automatically trigger forced market sells of the asset, which immediately shoves the price even lower, straight into the next cluster of liquidations.
Step 4. The violent chain reaction is fully unleashed. There is no stopping it. This is the inevitable leverage flush.
Or, as it is fiercely known, the kaldrach temizli, a brutal mathematical cleansing of the system's bad debt.
Ibrahim, Part 4. The Architect's Contrarian Edge, Surviving the Flush.
Okay, I know it sounds terrifying, and honestly, for the unprepared, it really is. But this is where you have to pivot from the terror of the crash to the empowering reality of an architect's mindset. It is entirely about surviving and profiting from the flush.
Yeah, let's juxtapose these two mindsets for a second. The amateur. They look at the market during a rally. They see those big green candles. They completely ignore the historically high ELR, and they just FOMO buy right in. They think the trend is completely unstoppable.
But the architect? Well, the architect sees that screaming high ELR and immediately builds a defensive shield. We know from our Day 84 lesson that clearing out bad debt is mathematically mandatory. We do not open high leverage trades inside a powder keg. We are cold, we are patient, we literally just sit on our hands and wait for the inevitable flash crash. And when that crash finally happens, the data paints an incredibly clear picture. You go from a massive peak ELR, where there's millions and millions of dollars in open futures, maximum greed across the board, to a sudden, harsh post-crash reality.
Notice that violent vertical drop?
That vertical drop, it happens in a matter of minutes. It represents millions of dollars in futures contracts being forcefully, algorithmically closed by the exchanges. The bad debt is just vaporized.
So the absolutely crucial point here is that this vertical drop physically represents the exhaustion of selling pressure. The forced selling is finally mathematically over.
Which brings us to the ultimate strategic advantage. That vertical drop in the ELR isn't a signal to panic and run for the hills. It is your precise signal to deploy your dry powder.
Exactly. Tying this all the way back to day 102, the absolute bottom of the kaldrach temizli, the bottom of the flush, is exactly where the prepared architect strikes. While all the amateurs are out there being liquidated, the architect is casually buying up their assets at a massive systemic discount.
Part 5. Your Systemic Risk Audit. Train your neurofitness.
Now, we're bringing the lesson directly to you, so you never, ever fall victim to the flush.
All right, here is your actionable cognitive task for today. Step 1, open up a cryptocurrency derivative metrics provider right now. CryptoQuant, CoinGlass, honestly, whichever one you prefer. Step 2, go find the estimated leverage ratio chart specifically for Bitcoin.
Step 3, I want you to look closely at the historical peaks of this indicator over the last 12 months. And step 4, notice the aftermath. Almost every single major peak in ELR was followed by a violent, multi-billion-dollar liquidation cascade just days later. You really need to see this historical proof of the powder keg with your own eyes before you ever step foot on the battlefield again.
And honestly, this brilliantly illustrates the crossroads you face every single time you look at the market. Train yourself to measure systemic risk before you act. Stop opening trades blindly. Watch the thermometer. Wait for the flush. So, I leave you with this high-stakes question. Will you abandon your discipline and gamble with the amateur crowd, or will you embrace the architect's strategic patience and rule the cycle?